So I'm running an experiment today. My father-in-law, who just moved here, I think 2 weeks ago, has both of my kids. I have a 3-year-old girl and a 7-year-old son. And at least typical energy level, if not more, for these two kids. And so we're seeing if my father-in-law can actually handle them, just him and those two. So they are out right now, and they should be back probably in about 15 minutes. So I need to make sure I get this done before they get back. But we'll see, because he told me he doesn't like when they yell or move around a lot. But they went to this indoor trampoline park, so hopefully them getting their energy out will work. So I'm, 50% sure nothing will happen, but I have my phone in my hand right now in case he calls and needs help. Obviously, making sure that they're safe is most important. So we'll see. It's an experiment. We're going to see how that experiment plays out. There is another experiment that is currently being played out that started a little over 6 years ago, with tens of trillions of dollars being printed around this globe, both in actual money printing and in deficit spending that will never be paid back because of the money printing. And that is an experiment. We are 6 years into the experiment. And, so far, in many ways, it's working. What if the black swan event was that Ben Bernanke was right and you could print all this money and get away with it? I don't actually think that's going to happen. I think the central banks of the large economies of the world will keep pushing and keep pushing and keep pushing until they finally get what they want, which is inflation. And the funny thing is, I think the thing that will actually finally resolve or create the inflation they want is gold getting reset. Is gold finally getting reset to a higher price, which will immediately devalue all the fiat currencies in the world. I think that will actually be their last step. So we are within an experiment seeing how this works. Hey everybody, this is RC Peck, and this is my weekend podcast. And the theme for this weekend is loved most of all. We are just starting out 2015, and the question is, what is the most loved of all investments on this little teeny planet? It's not oil. It's down 50%. It's not gold. Been falling 41 months. It's not silver. Been falling 47 months. What is the one thing? Well, the one thing is long-term U.S. government bonds. The world loves these things, which is kind of funny considering that the Fed printed $4 trillion and there were trillion-dollar deficits for multiple years. But we can't invest outside of this planet. We can't go to the Martian bond market or the Venus bond market. So we're stuck with the U.S. or the Earth bond market. And the largest bond market is the U.S. government bond market. And that's where people are putting their money right now. It is better looking than the German bond market or the UK bond market or the Japanese bond market or the Chinese bond market. It is the place to be. The currency of the U.S. Bond market is going higher. The price is going higher because, relatively speaking, its major competitors are going lower, and people are getting scared who have money in Europe and in the euro or in Japan or in the Japanese bond. They're moving it out of there and moving it into the U.S., the long-term U.S. government bond. And you can see at the screen here, this is a price chart of long-term government bond going back to, 2006? So pretty good amount of time. And the red line on the screen is the 200-week moving average. So you can see in a very kind of simple way, clean way, powerful way, that the moving average is moving higher. And that red dot on the screen, which is at the very end of 2008, beginning of 2009, was when many people thought the world, literally the financial world, was going to implode, completely collapse, and people were driving their money into the U.S. bond market, long-term government bonds, as fast as they could. And you can see today we're actually above that point. We're above the point of meltdown today. Now, we moved above that point in the last quarter of 2014, and now we're moving to its lifetime high, which happened in 2012. And I think we're going to hit that in the first quarter. Now, what happens between the lifetime high of long-term government bonds? This is a price chart, not a yield chart. And those 2008 highs, it could bounce between there, but we are going to test the old highs of the long-term U.S. government bond price, and that's going to happen very soon, probably in the first quarter of 2015. And the thing is, I think it's going to break through that. Now, it may consolidate and go sideways, but I think in 2015, we're going to see long-term bonds go higher in price than they ever have. And again, it's because, relatively speaking, the U.S. bond market is still the good deal on the planet. And that's going to push the price higher, which pushes the yield lower. What's interesting about this, at the same time, the U.S. Fed the Fed of the U.S. is going to attempt to start to increase short-term rates. So what does that mean? And this is my only chart of the day, just one chart for you to see. But what does that mean? That means the story of 2015, really the takeaway of the story of 2015 is long-term yields falling. Please remember, when the price of a bond goes higher, the yield goes lower. So I think one of the stories of 2015 is going to be long-term yields falling to a place that we could not even imagine. Again, because we all live on planet Earth. People who want to put their money in bonds, in government bonds, right now, today, the best government bond is the U.S. government bond. And so that's where money is going to flow. At the same time, Janet Yellen, I think, will increase rates this year on the short end. She can increase them from 0 to 0.25 on the short end. So we could see short-term yields rising and long-term yields falling. This does happen. Now, if this does happen and it continues into 2016, there is a very high chance of what's called an inverted yield curve, which means there is a very, very high chance of a recession, which means there is an incredibly high chance of our last clean-out correction in the stock market, which I've been talking about. This one could be anywhere between 35 to 50% correction. And then after that will probably be in 2016, 2017. And then the price to earnings ratio will start to rise again after 18 years of falling. So the takeaway in the story of 2015, long-term yields falling, that's going to push people into the U.S. stock market. It's going to give a cover for a lot of stupid money printing, because as yields fall, it's going to, the central banks are going to say, hey, our money printing is not creating inflation. It will happen. It's just not happening now. And we will see short-term yields rising. Hey everybody, this is just another step in helping you secure your portfolio and your future. Until next time, this is RC Peck.